Mike Tedeschi, Wealth Management Advisor at Perspective Wealth Planning with this week's market breakdown video. We just closed out the month, so in this video we're going to take a step back, look at the bigger picture, take a look at the indexes across monthly time frames. We're also going to talk about what we've been seeing in terms of economic data points when we're starting to miss things in a pretty dramatic fashion. So we'll jump in and we'll take a look at what that can mean for us moving forward. And as always, we'll take a look at the US dollar and some commodities as well. Let's start with the S&P 500. We got a chart going all the way back to 1997 up on the screen. As you can see, we have been in a beautiful uptrend off of the lows of last year, and that has continued. Last month, another solid straight month higher. The market is just grinding higher here and continues to look extremely strong. We take a look in at the Nasdaq. In the same way, we have the same type of chart. We have that nice breakout from the 2020 lows, and it has continued to grind higher, almost at all-time highs, and we're consistently making those on a regular basis. When we look in here at the Dow, we can see a very similar. I'm going to clear some of these lines off here from last week's video, so you can see continues to grind up over the last couple of months. We are really kind of putting in that flat top with higher lows. So we're going to look for that break over that 35,200 level, but really when we take a look at these monthly candles, we got highest monthly close ever. There's not a whole lot negative to discuss. Now when we look at the Russell, it's a little bit different. We've talked about that. We have not seen a new high since February. We're trapped inside this sideways range. The market is very clearly between that 2050 and 2350 level, and has been for most of this year. It had an incredible rip there at the end of last year, making that breakout back at 1700. We'd like to see this area of the market participate and continue to follow through for the upside. That would be good from a risk-on perspective. But as long as this just stays inside this range and continues to trade sideways, there's really not a whole lot to be concerned about. If this starts to break lower and we break below that 2050 level, that's going to change the way we have to think about the overall market. We're not there yet. Again, we're still trading inside this range. We're going to continue to look to see what that next movement ultimately is. When we come in now and take a look at the US dollar, we back this chart up on a regular basis, so this should be pretty familiar if you watch these videos weekly. Major support level in between 87 and that 91 level, and this goes all the way back to 2004 over here on this side of the chart. Right, this ended up being really important back in 2017, 2018. It's where we broke out in 2015, and again, that's where we have found that kind of area of support here so far this year. Now we haven't made that breakdown, but if you look at this, we also have not put in a higher monthly candle since we got down into the bottom of this range in the middle of last year. So nobody is in control right here. We're really just watching what's going on in this area. A move up above 94 would be good for the dollar bulls, and of course we'd have to break underneath that 87 to get that next move. We know this market moves very, very slowly, but it's one we definitely want to pay attention to because all the commodities and everything that we look at is priced in the US dollar. So how the US dollar is valued is really, really important to determine whether we have headwinds or tailwinds for the overall market and the commodity space. Speaking of commodities, let's jump in now and let's take a look at gold. All right, I'm going to clear everything off on this chart so we can get that nice fresh look for you guys. Highest monthly close before last year was right there in at that 1825 level. That is a close from back in 2011. All right, and we know that we made that breakout. We were not able to sustain that breakout. However, if we look at this on the long-term picture, this looks like a cup and a potential handle. We're looking for that break over that 1900, right? This has basically been almost a year now of a slightly downward movement, but you have to take the context of where it's come from. 2019, we were at 1,200 an ounce, all the way up into that almost 2,100 an ounce. So definitely coming from down below. A pause for a little while makes a lot of sense here, and is not a cause for concern until if we do break kind of below that 1650 zone. We go back and we can look at this chart going all the way back to the 90s, right? You have that cup, and then you have a year of trading down before it continues on. And then in 2008, 2009, you have a year of trading down before that move continues on. Like while we're inside this pattern right here, we don't really have a clear direction, but we know that we're coming from below, and so you look for follow through and continuation of the moves. We get back up over that 1900, really like the space. If we fall below that 1650, we'll have to change our tune. In the meantime, we're just kind of in a holding pattern. Silver. When we look at this from a long-term perspective, the major key level that goes all the way back to 2010 on that breakout zone is right in that 25 area, right? Again, it's not just one line, it's kind of this whole zone. It's really 25 to 26 right in here. You can clearly see that's been really, really important for the last decade. We broke above it last year, and then we have been trading in a pattern like this. We don't have a clear follow-through up or down. We have put in higher lows, but we've put in lower highs. So again, this is another area where we're just looking and waiting for that next move. If it's up, we're certainly going to follow suit. If it's down, we'll certainly change our tune in the overall market. But for right now, on a longer time frame, we're just kind of in a holding pattern there. Platinum has fallen back below that 1,050 level. I'm going to zoom in a little bit on a daily basis so you can see this. It's really happened here over the last couple of sessions. There is that psychological importance to that round number of 1,000. And again, when we look at support and resistance, it's not just one line like we have drawn on the chart. It's actually a zone, and the zone is really like this, right? It's kind of right down into this important 1,000 level. Underneath the 1,000, that's going to kind of change the tune for this market. Right now, it is trading in a really, really important zone. Bulls really do not want to lose the bottom end of this range. That would push this back down towards 800. And you can see when we look at this chart, we're nowhere near highs. It's been a much weaker metal for quite some time as we have continued to see palladium get more industrial use. And this chart, of course, is the best in the precious metal space, has been for quite some time, continues to rip and roll higher. 2,500 is a really, really important level. I'll zoom in again on a daily basis so you can see that. The last time we tested it, we shot right back up over the next 2 weeks. We're holding above that. That's going to be the key to this market. Under 2,500, I think you can test that 2,200 level, and I'm not as interested. Over 2,800, very interested in on the long side. Of course, if we make new highs, that would be a very, very good sign. Now, let's put metals away for a second, and let's take a look at oil. Now, we laid this out. We've been talking about these zones now all year, as the 77 area is an area of resistance. 75 to 77 was an area I said, well, we're probably going to run into a lot of trouble. We nailed that, and we've come right back down. And if you look at the other area we've got drawn on this chart, it's really that 65 to 68 level, which plays an important role going all the way back to 2009. You can see this is really kind of that inflection point in on the chart. You break underneath of it, we hold underneath of it, had a lot of battleground right here, and then a failure, a failure, a failure, and then a break above it. So this is that really, really important price action zone that we talk about. And in fact, if you're looking at it from a very long-term perspective, this whole area right here is really the key to this chart. If we break over 77, we're probably running back up and testing that 90 to 100 zone. If we can't push up above this, if we trade sideways for a while, no big deal. If we start to have considerable weakness from right here and this starts to turn lower, that is a major concern. We're going to continue to watch this, but really we're kind of in no man's land between that 67 and 77. We need to get to see ultimately where this is going to go. When we look at gasoline, we laid this out. I said that 225 to about that 240 zone is really, really important. Again, looking at a multi-decade chart, you can see all the importance back here in 2010. You can see the failure at 18, and you can see we're right up into this zone. A move over 240 probably gets us a chance to run back up to that $3. A failure here would be, kind of expected from a major price action zone. We talked about seasonality in one of the other videos. We're heading into a tougher season for gas historically. So a move lower here would make some sense. If you're looking at where this ultimately could fall to, you really don't want to see it fall underneath 180, which is the next kind of important level on the downside. If it breaks underneath of that, and then we've got some things to discuss in terms of whether or not this market really is, still looking bullish. So as you can see with a lot of these charts, we are still kind of in that holding decision-making zone where we don't have any clear uptrends, downtrends in the short term. Long term, we can obviously extrapolate, especially with things like gold. We're in an uptrend, but we haven't gone anywhere over the last 8 months, which makes the commodity space at this moment in time really kind of a holding pattern to wait and see where that next move is going to be. The next thing I want to take a look at is our economic data points, right? What are hard economic data points? Well, those are things like labor condition, housing, industrial performance, these, over the last couple of weeks, have really started to disappoint. They have mixed expectations by about 22%. Now, why does this happen? Well, economists, analysts, everybody, they tend to overestimate in both directions. When things get bad, they tend to downgrade way too far, right? And when things get good, they tend to upgrade too far, which moves that bar higher and higher and higher for markets ultimately to hit. And eventually, in both directions, you hit a point where the analysts have just missed the ball, and all of a sudden you start to see economic reports coming in lower than expectations, or on the downside, higher than expectations. Now, this was the third longest streak in 22 years where we had consistent beats. And that now has changed. What does that mean for stocks, bonds, and gold moving forward? That's really the important piece here. You can see when it comes to stocks, 6 months, a year later, we're still positive 75, 88% of the time. It doesn't seem to really affect things that much. It's almost as though the market has realized, that things cannot continue to expand at that particular rate and actually lower the internal expectations more towards reality and kind of shrug these data points off. When we get into treasuries, we have a really hard time over the next few months, right? Treasury market got hit very hard when we have seen this setup in the past. A year later, things have kind of turned themselves back around, but it's almost as if over the next couple of months, we could definitely see some issues inside the bond market. During this same point in time, we have typically seen the U.S. dollar struggle in the short term. A few months out, even 3 and 6 months out, we're only positive 50% of the time, a coin flip. A year later, we get back into that 63% positivity rate. But again, just like treasuries, we have a difficult time over the short term with this type of environment. And last but not least, when we take a look at the U.S. dollar struggling, that usually would mean we'd see some positive action out of the gold market, and that is what we see here. With the dollar only positive a quarter of the time, we see the gold market positive 50, 63% of the time. A month later and a year out, we're at 75%. So this is an interesting data set to continue to pay attention to. When we have those large economic misses and you see those kind of headlines come across the board, historically that hasn't made a big impact in the S&P 500 over the course of a year. In the short term, it definitely has a big impact on the dollar, treasuries, and even gold. So we'll continue to pay attention to those markets. As always, I hope you guys find this information useful. Feel free to reach out to me if you have any questions regarding the overall market at mtedeschi at perspectivewealthplanning.com, or pick up the phone and give me a call at 814-580-9881. Would love to talk anything related to the markets with you guys. And we will see you next week. Take care.